The euro has survived the region's debt crisis, but what of the euro area economy? With the bloc teetering on the brink of a new recession, economists Nuria Robini and David Levy and JP Morgan asset management strategist Michael Hood share their views on the road ahead.
The tail risk of the eurozone today, of course, are much lower than a year or two ago, thanks to whatever it takes, thanks to the OMT, the ESM, and the liquidity and policy action that the ECB has undertaken. However, the growth recovery in the eurozone is extremely anemic. Growth in the first and second quarter was very disappointing. Potential growth is low. Deficit debts in most of the eurozone are still high and rising as share of GDP. So I think there is a little bit of a complacency in the eurozone that the worst is behind us, that our debt problems have been resolved, that the eurozone is not going to break up. The risk of a breakup are lower, but the debt dynamics for most of the periphery is still very fragile. The recovery is going to be so mediocre. The deficit debt as a share of GDP will keep on rising. And therefore, over the medium term, I don't think that the fundamental problems of the eurozone of growth, of debt sustainability, of external competitiveness, of strong recovery of jobs and income have been resolved. The eurozone is still quite fragile.
When someone asks me whether the debt crisis is over in Europe, my first response is to say, which debt crisis? There's the one that everybody's looked at and been concerned about, which is the sovereign debt of various peripheral countries, and we know them well. The other question is the debt that doesn't get talked about as much, and that is the one that really concerns me. That is the private debt, the private sector's debt, households and especially corporations. The European ratio of household debt plus non-financial corporate debt to GDP is higher than that same ratio is in the United States, and higher than it was even in the peak in 2009. There is an inability, though, to really work off this debt because the banking system is really a zombie banking system, much like the Japanese banks were for much of the 90s. Until the political realities change so that the governments can recapitalize the banking system and bring in actually an accounting that will recognize the losses, it's going to be hard to get the European economy to function very well.
I think that the euro is much more likely to drift down than it is to collapse as the yen did. Certainly the European Central Bank would like to see a lower currency, but so far they've been very reluctant to engage in the kind of massive quantitative easing that the Bank of Japan has been embracing, and I think that they'll likely remain reluctant to do so. It's also the case that the euro area actually has a very favorable balance of payments position. It runs a fairly large current account surplus and also receives a lot of foreign direct investment inflows, corporate M&A related inflows. And so it's very difficult to get the euro down significantly from its current level. It's been frustrating for European policymakers, but I think they're going to be stuck for a while with a currency that's probably a bit more expensive than they'd like it to be.